that's kind of the way why I kind of shuffled everything around just to, we get it heavy for these first 3 weeks, and then let's add something not nearly as heavy for week 4. That being the case, though, it's not necessarily going to be a lot of test questions from this. This just keeps us from adding those heavy sections where more test questions can come from. There's not as much stuff to grab from these sections. Oh, we've got one more internal control section to do. There wasn't much here. I don't care for any of this, really. I don't find any real useful testing information here, honestly. It's about monitoring. We just answered a question about monitoring. That pretty much covers it, right? Monitoring is ongoing and continuous. They use this 4-stage process, but I can't visualize good test questions from this. As you're reading things like, how could they test me on this?
It's kind of general knowledge.
General knowledge, hard to really do much with it. Yeah, it's kind of broad in there. Yeah, nothing much. Okay. So jumping into a little bit of financial management stuff. Again, BEC is very much a mishmash of things. In this first 4 weeks, we've done a lot of cost accounting. We've done some stuff on internal control. Now we're doing a little bit on finance stuff. So this section actually followed the big capital budgeting section, the net present value and all of that, which we'll cover later. So they kind of segue into this by saying once they decide which project they need to do, they have to figure out how to finance it. So this is all about finances stuff. This is the introduction section here. Things we know, but maybe we haven't thought about these terms in a while. Think about your balance sheet. You got assets on one side and the source of them on the other side, right? They either came from liabilities or from equity. Who has claim on it? So those are all sources of our financing of our assets. So that's our whole financial structure. Capital structure is a little less broad than just a big financial structure. When you talk capital structure, you're talking long-term sources of financing. So long-term liabilities, long-term equity stuff, not the short-term stuff. We, in this section, are talking short-term stuff. So in questions for payables. So in our next section, these are short, very introduction sections. Breeze right through and feel like you've accomplished a lot, right? So the concept of, honestly, most of this stuff is like, I know this stuff, right? So the concept of short-term financing applies to obligations that are due within a year, current liabilities, right? So we're talking current stuff, not long-term stuff. Also, there are current assets that can be used to secure financing that would be short-term financing, like pledging accounts receivable as collateral, factoring accounts receivable where we sell them to a company and get money now, let them handle the whole collection process. Loans secured by inventory. So these are things we can do with our working capital. Ways to use our working capital to finance our assets. Working capital, by definition, is current assets offset by your current liabilities. Just introduction stuff. Payables. All right. I like this section. This is a useful section. So again, very, very basic review of very, very basic accounting things we know. We know what accounts payable are. Accounts payable, we buy stuff on credit, we pay it in a month usually, right? It's easy, it's flexible, there's no interest on it, there's no assets to pledge as collateral. And the best of all, usually, not usually, but a lot of times you get a discount if you pay it off early. The problem with accounts payable is they're not very broadly used, right? They're specific to certain use. Pretty much finances what you bought and you owe for, right? The payroll is linked in with whatever asset you just bought. You can't use that credit to spread over a bunch of other stuff, right? But a good takeaway from this for good test questions in BEC and in here is these discount terms. So the big takeaway is if you're offered a discount for early payment, you better do it, because annualizing the interest you're giving up on that, you end up giving up a ton of interest. And questions will ask you to calculate the effective interest rate associated with these types of discount terms. So revisiting what you learned in financial and intermediate and all that, these discount terms, 210 net 30, for example, means I get a 2% discount if I pay within 10 days, 210. Otherwise, I owe it all in 30 days without the discount. We should always take advantage of these because it's a big annual percentage rate. Here's an example of the calculation. So let's say you buy something for $100. That's what you owe. Terms are 210 net 30. So your discount 2%. So your discount would be a $2 discount. Doesn't sound like much. We're using simple numbers here. You pay $98. All right. I'm trying to remember. I think this is the right thing. Everything's kind of running together. I remember I shortcutted one of these topics. It was a calculation in contrast with what the book did. I don't remember if this is it or not. But anyway, so your rate.
Yeah, you did.
Did I is this the one I shortcutted?
Yeah.
All right.
It's
I was trying to
like
remember.
Kind of differently.
So
it's like time fraction of the year.
I think I shortcutted this, which means my answer is going to be very close to the true answer. Close enough that a multiple choice question will be really easy to answer, but maybe a little bit off from reality.
It's like 0.01.
Okay, this one was pretty close then. Okay. So I feel like my thing that I've got here is just a little bit more of a shortcut. So, you know, do it the way the book does or do it the way I do. It doesn't matter. Either way is fine. All right. So your rate is take 100 that you owe divided by the 98 that you're paying, and you get 1.0204. Take the 1 away from it. And you've got 0.0204. So that's 2.04%. So that's your rate for 20 days, assuming you pay on the 10th day. We always kind of assume we take full advantage of our time on these things, right? All right, so the rest of this is to figure out how many 20-day periods there are in a year. So you get 10 days to pay the thing off. So your rate is 2.04% for 20 days. There are 360 divided by 20 equals 18 20-day periods in a year. Right, so your rate is 18 times 2.04%, 36.72% roundabout. That's a huge annual interest rate, right? So I think we have some actual multiple choice questions on here. Erasing the clock on here. Okay. Sorry, I was looking at this as if it was number one, and I'm like, this is not matching up with what I've worked. All right, now I'm good. So number two, it says if a firm purchases materials on 210 net 40 discount basis, what is the equivalent annual interest rate using a 360-day year of foregoing the cash discount? All right. Here's my shortcut version, which will not be quite as exact, but it's quicker. All right. Your rate is 2% for 30 days. I think the version I just went through is their long version, maybe. I can't remember. Yeah, this way's better. Your rate's 2% for 30 days, right? 40 minus 10, 30 days. That's what you're giving up, right? You're paying early, but you're getting that 2%. So your rate is 2% for 30 days, 40 minus 10. There are 360 divided by 30 equals 12 30-day periods. In a year. So your rate's around 24%. That's my shortcut way. So if I'm doing my shortcut way, I'm answering this, right? The exact way, which isn't nearly as intuitive as this, one, because they don't give you dollar figures this time. So you just have to say, I owe $1 and I'm paying 98% of it, right? So I'm paying, that makes it kind of tricky, but get the 1 out of there. So 2.04%. And then multiply that by the 12 periods. So, that first little dividing and subtracting the 1, it's kind of an unnecessary step if you're just wanting to knock this problem out and be done with it, right? But your exact answer is 24.48%. So what I did on the notes page is their long version of it. But the quick version is just take that 2% discount, apply that to the 30-day period between the 10 and the 40. Figure out how many of those 30-day periods you have, multiply, and you're done. I like it better. That'll get you by. Close enough, right? To me, whatever you like. Yeah, to me, that's a lot easier. Check out number 5 here. You know, the big takeaway from this chapter is really effective interest of these different loan arrangements. Read the rest of our notes. You'll have to cut it off after we finish this section. But they go ahead and define accrued payables. We know what accrued payables are. Wages payable, that kind of thing. Rent payable, that kind of thing. You know, the financing, this is all about short-term financing. The implications are the same as accounts payable, right? We are paying our workers weekly, or I get paid monthly, so they're delaying paying me, so they're financing their assets for a while because of me. Short-term notes payable, they are really just defining different current liabilities. Notes payable that are short-term result from usually borrowing from a bank. Simple definition. Payment due within a year or less. Usually an interest component here. Here's where they really want us to do a little more work. Part of the arrangements of borrowing from a bank sometimes means you have to maintain a balance of some percent of what you're borrowing with the bank, a compensating balance. So it's like, yeah, we'll lend you $500,000. You need to keep 20% of that in the bank as a compensating balance and pay interest on it. Well, the effective interest rate of the loan goes up if there's a compensating balance, because you're paying interest on $500,000, but you really can only use $400,000 of it, right? So that changes your effective interest. So sometimes they might ask you a question like this one. What's the effective interest of this? Well, effective interest is what you're paying as a percent of what's available for you to use. Simple, right? So in this one, number 5, we borrow $20,000, 1-year note. We have to pay 6% interest, right? So interest is $20,000 times 6% is what we're paying. So $1,200. Well, guess what? We don't get to use all of that $20,000. We got to keep 10% of it in the bank as a compensating balance. So yeah, we're borrowing 20, but really we're only borrowing 18 because we can't access that without some penalty, right? So available funds are 20,000 times, and we only get to use 90% of it, right? 10% of it we got to keep in the bank. 18,000 is all we get to use. So our effective interest is the interest we pay as a ratio to what we have available. .67%. 6.7. So that's a good question that you would definitely want to be responsible for, and a good true to life question. Hey, we're charging you 6% interest, but really we're charging you 6.67% because we're not letting you have all this money to use. We got to keep some of it on hand with us. In other words, it's not yours, it's ours. So that's a good question there. The rest of these, I think we can probably stop here. I think we've covered enough. Our load along the way a bit. This is one of definitely the lighter little segments. So ways to finance things. So here we're talking, the title is standby credit and commercial paper. A lot of this stuff you already know. A lot of this is just everyday kind of knowledge. We know what a line of credit is. They don't give us really additional information on that we probably don't already know. You got an agreement. You have an amount, kind of a set amount. I can borrow up to that whenever I want it, or I may not borrow it. We've had a line of credit on my wife's business when we first got going on it. It's like we may need to get up the bank a little bit every now and then as we're getting moving. So we forgot what the line of credit was now, but we could borrow up to a certain amount. As we borrowed, they charged us interest on it, and as we paid it back, we charge interest on it anymore. So, pretty easy. Generally unsecured, obviously interest on it. May require a compensating balance. I don't remember if we had to keep a certain amount on the bank's books or not. Small town, people know people. Usually don't have to mess with stuff quite like that. A lot of times it's your friend at the bank who knows you and that kind of thing. Revolving credit agreement is kind of like a line of credit too, but it's more of a formal rather than informal agreement. Letter of credit may be something we haven't seen before. How important is it? Not super important probably, but you never know what kind of oddball question you'll get on CPA exam, and it doesn't take a whole lot of time to read that once and kind of have it, So this is a type of thing where the bank will, it's kind of a little agreement. The bank will pay someone else once certain things are met, and I thought that was kind of a vague description of it. So an example I put on the notes page 2. So a payment might be made to a supplier by the bank. Once the supplier submits proof that goods have been shipped. So, there's benefits to this. There's assurance of funding to the supplier. You don't have to pay in advance, that kind of thing. But they do make the point, a lot of times this is used in connection with foreign transactions. But the most important on this page really is commercial paper. I figure if you'll get a question on something from this section, it would be from this. So I would pay a little bit more attention to what this is and what the characteristics of it is. It's short term. It is unsecured. A lot of ways, it's like a short-term version of a bond in a lot of ways. I mean, there's no annual or semi-annual payments or anything because it's not that long of a term, but in a lot of ways, it's kind of like a short-term version of a bond. Short-term is unsecured, highly credit-worthy firms involved here. Usually they're about 6 months. They cannot be more than 270 days. Otherwise, there's some regulation requirements that you get into. There's different ways to arrange the interest. You can have a discount amount or however, sky's the limit on how you want to do the interest. Investors can buy these through a dealer, kind of like bonds. But the effective rate of these is typically less than just borrowing through a bank. And you can, like bonds, spread out larger amounts of borrowing across several different investors instead of through one bank, right? And compensating balances aren't required. So there's a lot of benefits to commercial paper, but I would take note of those characteristics. If anything, I think those might put you up on a test. So that's kind of it for this section. I think we kind of already have done something like this one last week, computing the effective rate. That's an important thing to know how to do in live and for the CPA exam, right? I don't think we did this exact one, so let's look at it. So we have Black Incorporated has negotiated a $300,000 revolving credit agreement with its bank. Under the terms of the agreement, bank will pay a commitment fee of 1% of any unused amount of credit. So this type of problem just kind of requires you to follow the directions. You don't have any special knowledge here other than, effective annual interest rate is computed by taking the amount of interest you paid as a ratio to whatever you borrowed and had available to you, right, to use. So they got to pay 1% on any unused amount of credit, 10% annual rate on funds that they do draw on, and they have to have a 10% compensating balance from the funds borrowed. Normally, this company would not maintain the amount of the compensating balance with its bank. At the time of the agreement, they borrow $200,000 of the $300,000 credit line for 1 year. What are we thinking on the effective interest rate? So this is a pretty complex, lots of pieces to it, calculate effective interest rate, right? So we'll just take it following the directions. What did they tell us? So they tell us Black will pay a commitment fee of 1% of any unused amount of credit. Now, they borrow 200 of the 300, so they have 100,000 unused that they have to pay 1% on. So that's $1,000. All right. They have to pay 10% per year on funds that they do draw, right? So 200,000 that they do use. So that's $20,000. And then they have to have a compensating balance. Now, this arrangement says they need a 10% compensating balance. 10% of what? Here, 10% of from the funds they borrow. So if they borrow $200,000, 20 of that has to stay on at the bank as a compensating balance. So So the effective interest rate is how much does it cost them to use the money? $21,000. As a ratio to how much do they truly have available to use. They borrow 200, but they have to stick 20,000 back on as a compensating balance, right? So that's the 21,000. So their effective interest rate is 21 divided by 180, which is 11.67%, which they have 11.66 is their answer choice. So that's okay. These are good problems. Effective interest rate's a good thing to know how to do. They can put all kinds of scenarios on you, but it all boils down to how much does it cost you to use the money as a ratio to how much do you have available to use. The rest of it's just deciphering what they say in the problem. Questions on that? All right, that's all I picked out on that one. The rest were kind of easy, just kind of real quickie. One of them was required you to know the maximum period for it to be considered commercial paper, 270 days. Yeah, nothing we need to go over together. So moving on to receivables and inventory, another quickie. Just a few little, here's some things that you can do with receivables. Again, this is all about using things to finance things. So we have accounts receivable. You can't use those to finance something. Yes, you can. You can pledge them as collateral, pledging accounts receivable. So you're using one of your current assets as collateral for a loan. So that helps you finance something. You can factor accounts receivable. So think about good old intermediate accounting when we did journal entries for factoring accounts receivable. Do you remember that?
Yeah.
I remember doing that when I was a student, thinking there's no way I'll ever come across this again in my life. And sure enough, one of our audit clients was a factoring company.
Really?
Yep, sure enough.
Oh, well, there you go.
I was wrong about that. I thought that was funny. So with factoring accounts receivable, we are taking the receivables, which are an asset, right? It's a future benefit when we collect the money. Well, here we're just selling them to somebody else, getting money now, and not fooling with having to collect and all of that mess. That is factoring accounts receivable. We're selling them to a factor. We get the money quicker, they collect. We can do this with two kind of circumstances. We can factor without recourse, meaning the person buying it from us has all the risk of whether they can collect it or not. Or we can factor with recourse, where they can come at us and say, we didn't collect it from this guy. And we're like, okay, here you go. Basic stuff. And then shifting gears to inventory, we can use inventory as collateral to secure a loan. And then there's some definitions that I don't feel like super important, but I just stuck them on there because, yeah, read it real quick. It doesn't cost you a whole lot of extra time to read over it. You never know. Floating lien, borrower gives lien against the inventory but retains control of it. Chattel mortgage, borrower gives lien and retains control but cannot sell specific inventory without lender approval. And then field and terminal warehouse. A couple more definitions of field warehouse is where inventory is placed under the control of some third party that holds it as security. Terminal warehouse, it is actually moved to some public warehouse where it's held as security. How important is this? Probably not at all, but why not? Go a little above and beyond, right? That's about it there. I say how important is this? It's not quite at all. This, though, the factoring thing, that's important. That's a big topic in financial accounting. We don't have to know all of that, but these basics, maybe, for BEC. Okay. Hold that thought. We're pausing the recording for a second. Okay, so I figured out what went wrong. Number 4 and number 5 are pretty much the same. The difference is number 4 doesn't make the deal where some of those goods were returned and the receivable disappeared. Number 4 is just straightforward. Here's what the terms are. 200 of it was factored. How much are they going to ultimately collect? So our calculations were correct. They're going to be charged the $200,000 times 2% factor fee. They're going to have the $20,000 held in reserve, so they're going to have $180,000 that will get 12% interest on that, 30 days, $1,760. So they'll receive. I had $200,000. They factored minus $20,000 that is hanging on with them, minus the $4,000 fee, minus the $1,760. 174, 240. All right, moving along. If there's no questions, long-term capital financing. I didn't see anything worth putting on the notes page for that. Long-term notes and financial leases. Really, I didn't see much to put on the notes for that either. I mean, we know what a long-term note is. Here we're borrowing from the bank. It's formal. There's periodic payments you often make, but not always. Typically, there's some kind of collateral. There might be some restrictive covenants, such as a compensating balance or something like that. So I started to write that. We know what leases are. I threw these little oddball terms on there just in case. Net leases, the lessee assumes the cost associated with ownership during the period of the lease, such as maintenance on whatever, taxes on whatever it is. Insurance, a net lease, the lessee assumes the cost in a net lease and also a pre-established residual value, so they're responsible for some other things in there. How important are those terms? You know, I can't say that about everything, that they're not important, but you know, I'm not going to stress over these little oddball terms. You know, that's maybe one multiple choice question that if you have no clue, you still got a 25% or better chance. Usually there's some throwaway responses in there, so makes your odds a little better, but you know, it never hurts to see it once or twice. So that's why I put stuff like that in my notes as I'm studying. It's quick, easy things to look at every time I read through. Eventually I'm going to learn it without realizing I did, you know. So that's a good strategy. Maybe not that important, but there it is, just in case, right? So I pulled, again, just one question here. And this is more of something we'll get into. I mean, we've done this a million times in your academic career, computing present values and stuff. We'll do it a lot more in the capital budgeting section, which is so easy because we've done it so many times. But they had one here. We definitely need to know how to do this. We don't ever need to forget how to do this. So it's just you know, we record long-term items at the present value of their future cash flows, don't we? That's what we do in accounting. So it's important to know. This one's super easy. It looks long and difficult, but it's a quick calculation. So we got a company entered into a lease contract with the LD company effective January 1st of 19 to lease a building. It costs $1,750,000 to construct and has a market value of $2 million. Expected life 20 years, residual value $200,000, lease for 10 years, annual payments $162,745.40, beginning December 31st of 19. Borrowing rates 10%, tax rates 20%. Here's your present value factor. So they're throwing a ton of information at you here. Obviously, you're not going to need the majority of it. So their question, which I typically would have read that first if I'm on this giant problem, I'm like, what am I looking for? In a financial analysis of the lease, which of the following amounts is closest to the after-tax present value of the lease cost? All right. After tax. So the lease is, you know, we're looking for the present value of any future cash flows. So the lease is an annual payment of $162,745.40. That's what we're in for. But there's a 20% tax rate since they're wanting us to do an after-tax cost of this. So we can offset by the tax benefit we get from this arrangement, right? So realistically, we're looking at a $162,745.40 payment. We're really only responsible for 80% of that after the 20% tax benefit of it, right? So our payment actually is $130,196.32. That is our payment after tax. And that's why I put this on here. It's a little unusual. You know, as many present value calculations we've done, I don't think I've ever seen do the after tax one. So like, oh no, what do we do? Well, here's our payment. 20% tax rate, 20% tax deduction. Net it out, $130,196. Let's discount that back. 10 years. And they try to throw us, they say this building has a 20-year expected life. Okay, that's fine. What's the lease term? That's what matters. It's 10 years. So we're dealing with this column. It's an annuity, so it's not a present value of a dollar. So now we're just like, okay, is it an annuity that begins today, or is it an annuity that begins at the end of this year? That's the difference between an ordinary annuity and an annuity due. All right. So today we're at January 1st of 19. Our first payment is December 31st, so a year from now. So this is an ordinary annuity. 6.14. 800,000. Interesting little problem. It's a good problem. It's very doable. It requires you to know a lot of things. It requires you to throw out stuff you don't need. I like this one. Questions? Okay. Bonds, my favorite thing from intermediate. I didn't use any of the bond problems. I didn't like any of them. Okay, well, we'll just talk about it. I think we've done bonds to death, honestly, in intermediate and principles, and more than you'd ever want. There's not a whole lot of, we're not doing effective interest method tables or anything in here. That's for FAR, right? We're in BEC stuff. BEC is more interested in the idea of using a bond to finance stuff. So we're talking, what is a bond? We better already know. More specific, what is a debenture bond? That's a term you see a lot. It just means it's unsecured. There's no collateral. Secured bond means it's got some kind of asset that's collateralizing it. Mortgage bond is secured by something, specifically here, real property, land, building, things like that. Callable bond, these definitions are easy. It allows the borrower to buy back, which means pay it off, right? Kind of think about that sometimes, but to call the bond, say, I borrowed money from you, I'm ready to be done with that. I'm paying you back, calling the bond in, right? That usually costs a little extra money to do that. Typically, a callable bond pays a higher interest rate than some equal bond without that feature for obvious reasons. I can see that as being a good test question. One you could easily reason through. The call feature kind of puts the lender at a little bit of a disadvantage. There's that uncertainty of, I'm not earning this interest anymore. So the premium attached to that, and a premium attached to them calling it too. You might have a conceptual question about, why would somebody do this? Why would they want to call the bond? So I put a little star by that. They might call the bonds. They might pay them off if the market rate of interest changes. This is something you have to think about. It's like the market rate declines below what's being paid. So the market is demanding a smaller interest rate. At some point down the road, then in other words, you're paying them more than they are demanding at this point. Things change in the market, and borrowers would be more comfortable with a smaller interest rate. You're overpaying interest now, so you call them, issue new bonds at a lower rate, right? So that's a good thing to know. That's good, nice test question type thing there. Convertible bonds kind of gives the lender a little bit of a feature there. They might decide that they want to convert that bond to stock in the company instead. So that's what a convertible bond is. So that gives them a nice little neat add-in. As such, those interest rates on those bonds are typically lower because they've got this special thing here now. And it's obvious, but the investors might convert the bonds if the market rate of the stock goes up. Super easy idea, but that's the type of test question you might get. So knowing what they are and knowing when they might come into play and knowing what interest rates usually attached to those types of things, higher versus lower, that's all good stuff. All good stuff to know. Zero coupon bond. So, back in intermediate, we had a stated rate, and that determined your annual or semi-annual interest payments. Well, a zero coupon bond doesn't pay any interest over the life. I think in intermediate books, we called it a zero interest bearing bond. Here they're calling it a zero coupon bond, same thing. So it's just the bonds issued at a big old discount. We borrow this, we pay way more back. The difference in what we get versus what we pay back at the end is the total interest, right? There's no annual payments. We just pay it all at one big old chunk at the end. Floating rate bond, pretty self-explanatory. Euro bonds, not as explanatory. Probably not as typical of a question either, but you never know. So Euro bond is a bond payable in our currency, but sold outside of our country. Registration and disclosure requirements are less elsewhere than in the U.S., so these can be cheaper. So we're selling it somewhere else. Okay. This is real obvious, but obviously important. Cost of debt. You could easily get a question on this, and it's usually like, here's the interest, here's the tax rate, what's the cost of debt? We did something really kind of similar to this in the problem we did just a minute ago. So the true cost of debt isn't the whatever 10% market rate. It's the 10% market rate offset by the tax benefit, right? So it's the interest rate times 1 minus the tax rate, kind of like we did right here. The payment times 1 minus the tax rate, right? We take away the tax aspect of it and net it all out. So that's what the cost of debt is too. The interest rate itself times 1 minus the tax rate. So, if we had a 10% rate of interest, but a 30% tax rate, 30% deduction on the interest. So we're really only in for 10% times 70% of that, right? So that's important. Here's this good old, just conceptual stuff from intermediate. Bond being issued at a discount, bond being issued at a premium. It's good to know when each of those things would happen, right? Par value means, you're receiving 500,000, you're paying back 500,000, right? The bond is designed to pay 10% interest. The market says, I like it, 10% is perfect. Well, it's designed to pay 10% interest. So the periodic payments I give you is exactly 10%. So we're all good. Give me what the face value is. That's what I'll pay you back. No adjustments necessary. Bond issued at a discount means I might have a bond designed to pay 10% interest with my annual payments. And the market might say, no, don't like that. I need 12%. So, well, this bond's designed to pay 10%, and that's what it's going to pay. How are we going to fix this? And then they're going to say, well, I'm going to lend you less money than you're going to pay me back, and that'll make up the difference. So I get the bond's issued at a discount. I get less money, I pay back more. That makes up the interest difference. Bond issued at a premium, I might say this bond pays 10%, and they say, hey, we're pretty comfortable with you. 8% would be fine. And again, I say, well, it's designed to pay 10. How are we going to fix it? Here, let me pay you a lot more up front. You pay me back less, and that'll make up the difference. You end up paying less interest. That's a bond issued at a premium. So definitely know when each of these things would happen. Market rate versus the stated rate. Good things to know. All right. Bond values based on the present value of future cash flows. So we would take the present value of an annuity for all the periodic interest payments There's a present value of a single sum for the amount due at maturity. We've done this a lot in intermediate. So we don't have to do it here and now. That's more of a FAR topic, financial accounting, CPA exam topic. Here it's more just concepts, really. All right, bond yields. This is kind of newish information in a way. So the current yield of a bond is the stated interest payment, the coupon interest rate, the checks that are going out as a ratio to the current market price of the bond. So that's a formula. Current yield, annual interest payments as a ratio to what's the market price of this bond. So current yield changes as market rate changes, right? Stated rate is what it is. So the interest payments never change, but the market price goes up or down. So the current yield fluctuates as the market price fluctuates. It's really the only formula we need to mess with. Yield to maturity is a term you'll see a lot. It's just another way of saying the expected rate of return. The market rate, right? Just there are so many synonyms you can use for this. It's the rate of return required by the investors, the current market rate, kind of like what we were saying up here, market rate versus stated rate. That's what we're talking about. Conceptual ideas that can show up, it's the discount rate that equates the present value of future cash flows to the present selling price in the market. It's the internal rate of return on the bond, and is another way to say it. It's putting into words all that stuff we've done in intermediate, right? It's the market rate. Just be careful of the different twists and turns they can take you on with conceptual type questions with this. There's a lot of ways they can kind of say the same thing. Maybe less important is this yield curve, but I think they emphasized it a little more than I expected. It just is a graph showing what the return on the bonds is at different lengths of time to maturity. The longer the term is, the more riskier a bond is. A bond due in 10 years is less risky than one due in 50 years. A lot can change in 50 years, a lot more than can change in 10 years. So the required rate of return certainly is higher for longer term bonds. So this is a graph that shows the relationship of the rate of return as the length of time goes up. Less important, but there it is. You see it once, you know it, right? Okay. A lot of this is just reviewing ideas from what we did in great detail in intermediate 2. So we're kind of scratching the surface a lot more on this than we did in intermediate 2. But the questions they have are very basic. They're all kind of definitional type things. So I didn't see any of them worth looking at. They had a question on Euro bonds and the fact that they're cheaper because there's less red tape to go through. So I don't know. They could have done better with questions, I think. Well, questions for you guys. Preferred stock. So we know what it is. It's a class of ownership, but there's priorities on it, right? It's preferred. Priority claims on assets or earnings before common stock. Generally, it's with respect to a dividend. If we're a preferred stockholder, we get dividend paid to us. All of us preferred stockholders get our dividends before any of the common stockholders get whatever it's done, right? We are interested in assigning value to these things as part of BEC. And that comes a little later in a different section too, more so than now, I think. But I think we do have maybe one or two to calculate, but we'll look at in a minute. But when you're valuing a preferred stock that you have, an asset that you're, not an asset, a preferred stock holding that you have, the value of anything is whatever future cash flows come from it, right? Discounted back to present day. That's how we value a bond. That's how we value a company. That's what we do when we value something. We figure out what are the future cash flows, what is it in terms of today's money, that's the value. It's hard to predict all that stuff, but once we predict it, that's how we assign value. So with a preferred stock, future cash flows are a dividend. So we'll take that annual dividend that is supposed to come to us every year forever and ever and ever and ever. It's called a perpetuity. So to value preferred stock, we take that annual dividend and divide it by the interest, the market rate, not our market rate, the cost of capital to us, our required rate of return. That's the value. So we take the dividend, divide by our interest rate that we demand, and that's what it's worth. So that's real easy, and it's important. You might have a question that kind of flips that formula and asks you, what is your expected rate of return on preferred stock? Well, then you take that dividend as a ratio to market rate. It's the same formula, we're just kind of answering a different thing, right? So pretty easy stuff. Let me add a couple of things here. Different preferences on stocks. You can have cumulative preferred stock. That's when dividends, they call it dividends in arrears, unpaid from prior periods is what that is. So companies don't have to pay a dividend ever if they don't want to. They might skip a year. If they skip a year and then pay the next year, well, if you have cumulative preferred stock, you get last year's dividend and this year's before common stockholders get anything. So cumulative preferred stock, any unpaid from prior periods are paid before common stockholders get paid. That's what cumulative preferred stock is. There is participating preferred stock. That's a preference that you might have on your preferred stock. Once you get your preferred share of dividends, you also participate with common share of dividends. Sounds like you might participate in board meetings or something, but no, you just participate in preferred version and the common version. You get shares of each. What that sounds like is voting stock is what that would be. That's a rare thing. But I can see that. So good terms to know. You never know. That might be important. So I got that added to our notes. All right, let's see what we got here. The review on here is this. All right. So these are just good, easy computational questions that you'd love to get. And you will get these types of things for preferred stock, for common stock, for all kinds of things. We're all about valuing things. So this is one of the things you might be asked to value, or in this case, you might know the values and be saying, what's our expected rate of return here in this situation? So with this one, it says a company issued common stock and preferred stock. projected growth rate of common stock is 5%. The current quarterly dividend on preferred stock is $1.60. The current market price on preferred stock is $80. Current market price on common stock is $95. So they told us all this mess about common stock, and they asked us, what's the expected rate of return on preferred stock? So all that stuff about common stock doesn't matter. They want us to tell what is the expected rate of return on preferred stock. All right, well, if you remember, you made a note about that. It's the annual dividend as a ratio to the market price. So the annual dividend is $1.60 times 4. That's a quarterly amount, $1.60. So times 4, $6.40 per year. Market price is given, it is $80. So the expected return on this is the dividend as a ratio to what the market price of it is. It is 8% return. And costs you $80 to have one of these shares. Your return is $6.40. 8% expected return. Pretty basic idea. They could have flipped this around and said, this thing pays $6.40 per year, and the expected rate of return is 8%. What's it valued at? You take $6.40 divided by 0.08, and you say, okay, it's $80 value. Just same numbers, flip-flopping them. Right? So they can easily ask you either thing. Questions on that? Good stuff to know. Number 2. Okay. Their question is, which of the following approaches describes this company's best strategy? All right, so that's what I'm keeping in mind as I read this. Company is publicly traded. They want to obtain some money. Cost of capital is a factor in their decision, obviously. They can either issue preferred stock or debentures. You know what debentures are now, right? It's bonds that are unsecured. That's what a debenture is. So their underwriter said preferred stock should have an annual dividend payout of $6 and an issue price of $103 per share. The debenture should have a coupon interest rate or stated rate of 9% and an issue price of $101. 40% tax rate. Which should they do? All right, so let's see how they've organized these answer choices. So the way that we're going to have to answer this is they're essentially asking, what's the cost of the debt? What's the cost of the equity? So we just essentially need to calculate the cost of each of those and then answer the question, right? So this is a good question. So what's our cost of equity? Cost of the preferred stock. We have that in our notes right here. It's the future cash flow as a ratio to our oh no, I'm sorry. This formula. It's our annual dividend as a ratio to the market price. So the cost of the preferred stock is $6 annual dividend. That's not right. There we go. $6. All right, come on, Ken. know what.
Does it have to be sent to withdrawal?
Maybe so. All right. $6 annual dividend. As a ratio to the, here's our dividend number, the market price that the underwriter has determined it should be. You know, that's what it's supposed to sell at, right? 103. That's what it's selling for in the market. 103 market price. So we're talking a cost of 5.825%. We have to pay $6 a year to obtain that $103. So that's what it costs us. 6 as a ratio to the 103. We have to pay 5.825% of what we get. We don't have to, but we will. Preferred stock, we're kind of committed to it. So that's the cost of the equity. Cost of the debt. So there's no tax benefit here. You don't get a tax deduction for dividends. We know that, right? We do get tax deduction for interest on debt, though. So that's why the cost of debt is typically cheaper than the cost of equity. It's a big advantage of financing things with debt. It's cheaper, but disadvantage is debt's riskier. You got to pay it back, right? So the cost of debt would be I went about this a couple different ways just to kind of mess around with it, I think. I just kind of, you know, they tell us that these are going to be issued at 101. Yeah. They don't tell us 100. They don't tell us that the face value of this is $100, but you can, based on what you know, bonds are issued usually at $1,000 increments. Here, it would definitely be a $100 increment, right? So it's issued at a slight premium, 101%, or I'm sorry, yeah, 101% or $101. But I just kind of did it this way. I said, cost of debt is, you know, at par value. It's at a premium, but at par, it would have been a 9% interest that we would be paying times 1 minus the tax rate. So taking out the kind of deduction we get, we're essentially paying about 5.4%. I thought that was good enough to answer the question, right? So that's how I went about it. You could also have done no, I think that way is easier. Let's just not confuse it. So around 5.4%. So the answer is we should issue the bonds, right? They're cheaper. So we should, A says we should issue the debentures since the after-tax cost is 5.347. We said 5.4. I figured that's close enough. It would be less than the cost of equity of 5.825. Okay, that's right? I would look at the others just to make sure because I don't like having this inexact number here. But they're saying cost of debt is 5.347. And the cost of equity is 6%. So that's not true, right? Cost of equity 6%, not true. They're saying the cost of debt is 9%. That's not true, right? So that's the easy, quick answer. You don't have to go through an exact calculation on this. But if you did want the exact calculation, well, your stated rate's 9%, right? base is $100. So that's a $9 annual interest payment. And we're talking $101 is the amount being dealt with here. So 8.91%. Times 60% should be that more exact number. Let's see. Dang it. Calendar and calculator looks great. 0.0891 times 0.6. 5.346. What was it? 5.347. Close enough. So. Two ways to kind of get at that cost of debt number. I like the quick way. I didn't need an exact number. But if I did, this would work. What we're paying as a ratio to kind of what we're in for there. $9 on 101. Questions on that? Number 5, what impact will the issuing of preferred stock have on the following things? What will it do to their long-term debt? Preferred stock is not debt, it is equity, so it will not affect our long-term debt at all. All right. So no change. No change. No change. So that's easy. What will it do to our debt to equity ratio? Well, it's going to increase our equity, right? No change to debt. So now we've got the same amount of debt divided by a larger number on the equity side, right? So dividing by a larger number means the ratio is smaller. Right? So the ratio increases. So neat. That's a good one. Typical type question. Number 7. Whipco has determined that its pre-tax cost of preferred stock is 12%. If its tax rate is 30%, which of the following is its after-tax cost of preferred stock? Trick question, right? You have no tax benefit attached to preferred stock. So your tax rate doesn't affect your cost of stock, your cost of equity. So still 12%. It's a good question too. So same. No deduction for dividends. It's important. Lots of concepts here with a little bit of calculation. Not heavy calculations. We'll do the same with common stock. Preferred stock pays a constant dividend. There's growth involved with common stock. So common stock, we know what it is. We better know what it is. Basic ownership in a company. There's lots of characteristics that we should know, but there they are, just in case you want to review. Limited liability to shareholders. They are only liable for the amount they've invested. They have a residual claim to assets and income. They have a right to vote. They have a preemptive right, which means that if new stock is issued, they get the right to buy in first to keep their same percentage ownership that they already had before. all good characteristic things to know. Cost of common stock is usually higher than bonds or preferred stock. So this is the most expensive way to finance your stuff, but it's less risky because you don't have to pay a dividend if you don't want to. Valuing common stock is this formula. Dividend in year one, not the dividend in today. It's the dividend a year from now. That can make these computation problems a little tricky. They might say the dividend last year was this. Bump it up a year. So dividend in year one, and with the preferred stock, it's just the dividend, right? It's a kind of a constant rate as a ratio to your required rate of return. Well, here you still have a required rate of return, but you expect stock to grow in value, right? That's kind of your expectation. So, you might require a 10% return, but you might require a 10% return, but that stock is expected to increase in value at 1% per year. You're already getting a 1% return as part of that. So your required rate of return can be offset by that to value this stock issue. So it's dividend year one divided by the required rate of return minus the growth rate. So we always kind of write that as D1 or I minus G. Easy little formula, comes into play a lot. They do use these formulas, but they make us find a different piece of it than just the price of the stock. So look at number 4. It's the more straightforward, I think, of the two. This company's stock is currently selling for 100, so they start out giving you the market price of the stock, right? So our formula is the value of the stock equals dividend in year one over the required return offset by our expected yearly growth of the thing. So this thing is currently selling for $100. Well, they give us the value. And we'll pay a $4 per share dividend. We'll pay that. If the dividend is expected to grow indefinitely at 5% each year, what's the required rate of return that will, what return do we require above that? So we're looking for this. We already have that. So it's just a simple what makes that formula work. So the rate that would make that work is 9%. It's one of those where it's easier to just, it's not 4%, it's not 5%, so it's either 9 or 20. So I just kind of plug it in, see which one works instead of going through the algebra of it. So backing up to number 1, a stock is priced at $50 per share and is expected to pay $5 in dividends. And trade for $60 per share in 1 year. All right, so that's where they're trying to throw a curveball at you. The $60 per share, that's the price of it a year from now. We're pricing it, the price of 50 is now, the dividend is $5 in year 1. That's the information we have. But they don't flat out say, oh no, what's the growth rate? It's this. So that's why they tell us the $60 that it's going to sell for. We've got to figure out that growth rate number. They're mean to us and don't say it's going to grow at 5% or whatever. So we've got to figure it out. It's easy enough. It's going to grow by $10, right? And that $10 is a ratio to what's it growing from, right? So it's just a percent change. 60 minus 50 over 50. So 10 over 50 is a 20% growth. So the change divided by the base year, right? 50 is our base year. So back over here, $5 minus 20. So 5 divided by what would give us 50? These things are easier, just eyeball instead of crunching out the algebra numbers. We can do that if you want, but you end up having to do all these algebraic steps that kind of take some time. I'm looking up here and saying, well, it's not 10. That gives us a negative number. It's not 20. You can't divide by 0. So it's either 25 or 30. So what's 5 divided by 5%? $100. So we're wanting it to equal 50. So it's not that. So it better be 30, right? So 30 minus 20 is 10%. 5 divided by 0.1 is 50. So there you go. 30% makes it work. That's easier to me than, you end up having to get the 5 by itself and you multiply each side by I minus 20%. It just gets complex, more complex than just plugging and seeing what works. So that's what I would do. So 30% makes it work. Makes sense. It's all just kind of using that formula, using the crazy way they give you information. I feel like if you've seen this one for the first time, we might be a little lost. But then if we see one like this, it's like, oh, they give us a way to figure out the growth rate. That's easy. And, you've seen it, Questions? That's all I did. Okay. The questions on this. They're good, but I didn't see any of them that we needed to specifically look at. I thought they were pretty straightforward. They got more on cost of debt, cost of equity. Number 2 was good. Maybe we could look at some of these, but I think I knew we'd be kind of running short on time. I was like, these are pretty straightforward. But anyway, they give us more terms in this section. Operating leverage, financial leverage. These are good terms to know. They get thrown around quite a bit. I would definitely know those definitions before I would know the formulas. I don't know how important those formulas are compared to the definitions. So, I wouldn't worry as much about this. But operating leverage is just the idea of the extent to which fixed assets or fixed costs are involved with your operations. Not necessarily fixed assets, but fixed costs. The more they're fixed costs, the more risky, right? You're just kind of committed in with those for the most part. Fixed costs are high, then changes in sales can kind of really affect your operating results. If you're higher on variable costs, well, changes in sales, less sales, you don't incur those variable costs on those, and it's less of a deal, right? The more fixed costs you have to recover, the more you're kind of committed to, man, we better make sure and sell enough to recover those fixed costs, right? So that's the idea of operating leverage. Greater the fixed cost, the greater the risk. The flip side of that is if sales are going up, then there'll be a larger increase on return on equity. So there you go. Degree of operating leverage. So it's the idea of what effect does changes in volume have on your income? So degree of operating leverage is the change from one period to the next in income as a ratio to the change in the volume from that year to year. Not as important, in my opinion. All right. Again, this is my opinion. I wouldn't prioritize that formula. I'm not saying it couldn't show up. I'm just saying that's a big old formula to think about. And they may give you these formulas for this. I don't know. There's always a possibility of that.
I mean, you can also kind of reason through that too.
You can reason through it. So yeah, if you know the definition and you kind of have a general idea, oh yeah, all right, so there's change in this, and okay, I got it. Yeah, so you can kind of reason through that. But yeah, I think more important is the definition. And honestly, I think more important is this definition than the operating leverage one. Financial leverage, that's a term you really run into quite a bit. And that's the extent to which you use debt to finance your assets. Debt is risky, but debt is cheaper. So your financial leverage can really work for you, or it can work against you, right? The degree of financial leverage, again, that formula, I probably wouldn't worry about it so much.
That just takes me back to the captain.
Yeah, exactly. So y'all had to do all that. And that's another thing. You can kind of rely on your previous knowledge. But it's the percent change in earnings per share as a ratio to the percent change of EBIT, which is earnings before interest and tax. Again, I wouldn't prioritize those formulas, but I would prioritize the definitions. My opinion. And when I say I wouldn't prioritize those formulas, I would be a real jerk to put one of those test questions on here. So I wouldn't do that, right? That would be mean. So there you go.